Hey everybody, welcome back to the channel. So today I want to take a look at some of the rules that prop firms have in place during some of the challenge phases or as a funded trader. Now, a lot of times when we start comparing prop firms, we like to see some of the differences. Now with FTMO, people often call out the fact that you cannot trade around news events as well as holding positions over the weekend. And that can be seen as a good thing or it can be seen as a bad thing. But often it's that sort of blanket sweeping statement saying it's bad because you can't do something rather than it's actually more advantageous and protects the traders because you can't do something. So what I want to do today is take those two rules, break them down and see actually how they can be advantageous in our trading. So first off, just want to point out these rules are only for funded traders. If you are going through the challenge and verification phase, you can do whatever you want. You can trade around the news events and you can trade over the weekend as well and hold positions. It doesn't make any difference. Trade how you want to trade. Now, if we come to the first rule around trading news, a lot of people perceive this as actually quite a bad thing because we're just told you cannot trade rules. But when you look in detail at the actual rule itself, it's broken down quite specifically. It's you cannot trade between 2 minutes before and 2 minutes after a restricted news event. Now, when you look in the economic calendar with FTMO in the client area, you can very easily see how many news events are coming out during the week, and there are some weeks hundreds. They range from low events up to high events and obviously restricted events. And obviously they often only relate to certain currency pairs and certain regions. So for example, I'm trading in the UK and US time zones. I don't really worry about what's going to happen to the Australian employment rates or the Australian bank interest rates. I generally don't have trades open at that time, and if I did, it's not going to be worried about those currency pairs. Again, I'm only trading predominantly cable, FTSE or gold. So again, if the Bank of Australia does something, it's not going to affect any of my positions greatly. And obviously if you look at the number of restricted events per week, it's typically only about 3 to 5, sometimes maybe 7 restricted events per week. So if you break that down by the number of minutes you are unable to trade, let's say there's only 20 minutes a week that you can't trade, and if you then break that down to how many minutes you have per day available to trading across all time zones and all regions, you're only being restricted to a fraction of a percent in your trading week. Again, not a huge imposition for most traders, and I'm sure most people can work around that. Then as we look deeper into the actual rule itself, it only then starts applying to Forex pairs. And again, it's only certain pairs on certain news items. So if I'm trading British pound, I'm not too worried about an Australian news event. If I'm trading gold, it's not going to affect me because it's only looking at the Forex. Again, oil inventories is quite a clear one. If you're trying to trade oil around when the numbers come out, that's typically when the biggest spike in the oil price is going to happen within a week. And you'll see most times on oil, it can range quite easy between $1 and $2 in a barrel price in a matter of minutes. And these are just things actually there to protect the traders. Now, some people might say it's actually restricting traders from making very big profits. If you're able to set an order around some of the news events and obviously trigger into those, you could make significant profits. But what I found personally is that if you are placing orders with MetaTrader, you don't always get filled at the right price. Now, when these news events come out, price can move massively in a very short period of time. And trying to get those prices filled is often very, very difficult. So let's say, an example, in MetaTrader, we put a buy stop order above the current price, expecting price to break out on this news event. And we get a take profit, let's say on gold, $3 away from our entry point. Now, if we don't get filled at our first price, and there's a massive amount of move, we can actually get filled in above our take profit and the trade close out instantly for a loss. Now, for me, that is actually quite a bad practice, and I wouldn't want to be trading around those massive high volatile news events. So when I look at the restricted news events in detail, for me personally, there's only typically 1 or 2 per week or even per month that has an effect on my trading. And again, I wouldn't want to trade in those times. Non-farm payroll is typically the biggest news event that comes out in the month that has a massive effect on currency, indices and gold. Now for me, what happens generally in the morning leading up to that, there's very little volume, there's not much volatility in the market, and price is just very, very static. News comes out and price just does anything. It can go up and go down, it can do both. And after that point, you have to wait an hour until the US session opens and start divulging the data to then really see what the impact is going to be on the market and the future sessions. And if we look at the charts in these times, we can see some huge swings. Now, gold, we can see sort of $10, $15, $20 moves in a matter of minutes, and on some of the forex pairs we can see 50 to 100 pips in a matter of minutes. Now yes, it's very nice to get on the right side of those moves, but often the times is we don't get on those and it goes against us. So for me, I always like to take the cautious approach, and when non-farm payroll figures come out, I just don't trade on the day. For me, it's just not worth the risk of getting into the wrong trade or the wrong side of the trade and just taking some big losses very, very quickly. So as we can see from the news rule with FTMO, yes, it is an inconvenience. We have to monitor those and be aware what we're trading at a particular time. But again, it's not the biggest deal in the world, and as traders, we should know when the big news articles are coming out. We should know when these massive events are happening, and honestly, from my point of view, I'd rather not be in the market at those times. I've made a mistake previously, and I have traded a currency pair around the FOMC announcement, and again I did make a profit and FTMO took that away from me. I've learned from that, and from my point of view I'm just more and more careful around news events. So if you look at the rule around holding positions over a weekend, and often they say no, because when you're trading something with FTMO, you're not able to hold that asset if the market is closed for any more than 2 hours. Now typically in Forex gold indices, the market will close for an hour almost at the end of the US session, then open up again before the Asia session starts. So we are able to hold overnight in those assets. It's not really an impact. If we are trading some of the equities, so if we're trying to trade Tesla or anything on the NASDAQ that FTMO allowed us to trade, then when we get to the end of the US session, there is going to be a greater than a 2-hour market closure, and so if we're trying to trade some of the stocks with FTMO, we're not able to hold overnight. Now, if you ever looked at stocks, you can see some massive gapping on them. It's very easy for, let's say, some of the tech stocks, Tesla or any other ones, to really gap massive amounts. And again, it's really just putting that sort of... Now, although gapping isn't very common in the Forex market, what we have to be aware of also is the spreads. Now, often when the sessions close at the end of the US session on the Friday and before they open up in Asia, the spreads will widen. If you are looking at a 0.5 or a 1 pip spread, that can often widen up to 10, 15 or 20 pips. And again, that's not in the control of FTMO, that's the control of the broker, and that's common across all platforms globally. So let's just say we're in a trade and we've got quite a tight stop loss, let's say 20 pips, and we are down 5 pips and we don't close that trade out on the end of a Friday, and we have to wait until the sessions open up. Again, because MetaTrader doesn't allow us to modify or change our stop losses as soon as the market closes, we're at a risk of that when the markets do open and the spreads are wider, being stopped out. And again, that's just a safety net that I believe FTMO put in place to actually protect some of the traders. A lot of traders go with very tight stops rather than looking at the longer term swing trades, and therefore might have a 50 or 100 pip stop. Those widening of spreads wouldn't make any difference, but in a lot of the traders' trading styles, they have quite tight stops, and we don't want anyone to be stopped out. You could have 1, 2, 3 trades open, you get up on the Monday morning and you're already down by 3-4% just be having those stops coming in. And it could be that, let's say the spreads hadn't widened, they could have actually not hit your original stop loss and just carried on and hit a target. It's just protecting the trader, in my opinion. And for me, personally, I just think it's good practice to close the trades down at the end of a Friday, not have that worry and that stress of what could happen over the weekend. And as I said before, that the gaps are quite rare, but it's not impossible for a major event to happen over the weekend. There could be a terror attack, a war, a natural disaster. Anything can actually happen to have a serious impact on the financial markets. And again, we've seen it many times before, even if you look in the past 2 years, just with the health restrictions that come into place, that has massive knock-on effects to the market, not just on the stock markets, but also the Forex markets, and that then causes any number of things to happen with price. It could work on the other side. It could be that things gap up and therefore we'll hit our take profit, but there's always that risk. And for me personally, I'd rather close out and not take those risks and trade as risk-free as possible. So yeah, I hope you enjoyed my video today on the two main rules that FTMO put in place when you're a funded trader. And also, rather than look at them as negatives, flip them around and have them as positives, and potentially change your trading style to incorporate those and make sure you are a much better trader and not get caught out by these small things and can hold your account for a much longer period of time. So as always, I'll see you again soon. Cheers for watching. Bye.